How to buy apartments in the next 90 days. 90 days. Most people, like you said, why you came in here tonight, you're looking to kind of understand how to get into this game. You've maybe seen some stuff online. You came across our stuff online. You've maybe watched some YouTube stuff. Maybe taken some free courses. Maybe you've taken some mentorships already. Maybe you're in stuff in communities. That's all awesome. Definitely need to be attached to things so you can learn this game, because a lot of folks will come into it with, some experience or zero, maybe a complete novice. Maybe you flipped some houses, done some wholesaling, maybe some rentals. So you have some background, you know the game, you understand it, but maybe from a single family perspective. And now you want to say, okay, if I were to go buy a 5-unit plus building, how do I do that? How do I find it? How would I analyze that thing, to determine is it a good deal or not to move forward? Okay, great. I've found it. I've analyzed it. It's a good deal. Like, how do I put it together? How do I structure it legally and financially? How do I do the capital and all that and put it together? Close the escrow, and then great, now I own this beautiful building. How do I manage it? And how do I do all this so I don't get myself and my investors or people I have into a money pit? And how can I learn this game and do it the right way? Because there's nothing more expensive than trying to do things completely on your own, which is totally fine if you have that ability. Most people don't. And then you get into big money mistakes, right? We've all been there. So yes, syndication is kind of this fancy word that gets thrown out there. You may have heard it a lot. All that means is you are putting money together with other people to go buy commercial real estate or anything. When you syndicate, you're syndicating money. You're putting money together. You're collaborating money together. That's all it means. It's a fancy word term that gets thrown out, but all it means is I'm taking my money in conjunction with OPM, other people's money, syndicating it together to go buy things. And then for that, you get returns and you structure things and stuff like that. We're going to get into that tonight. So, okay, here we go. So the question that I get a lot from folks is why multifamily, right? Versus say a single family home or doing other types of real estate investing. Why multifamily? Why do you talk about this? Why do you invest in it? Why do you preach about it so much? It's really for these main reasons. You get paid 5 to 8 different times throughout the ownership of the property. There's not too many other asset classes where that can happen, okay? Very few, if any. You get economies of scale. I was chatting with my buddy Jeff the other day, and he said, Justin, I have 12 single-family homes I'm buying in Georgia, all in a similar neighborhood. And I said, that's great, Jeff. Why aren't you just buying one building that has 12 units in it? And he said, well, I just don't understand it. Like, I don't know how to find those deals, first of all. And then if I do, like, how do I even analyze it? And if I analyze it, how do I structure it financially? How can I put it together? Can I even afford to do that? Can I do that? And then once I do that, well, great. How do I manage a building like that? But I understand single family, so I go that route. So let me ask you a question real quick. Because when you get to these economies of scale, okay, when you're dealing with multifamily, one roof, maybe one set of repairs and maintenance in one building. You have one insurance policy, one mortgage, okay? You're dealing with singles on a building, right, where it's all encompassed, plus one building to go to, right? You're not having to go drive around. The other best thing about it, think about it. If you have a single family home, if your tenant moves out, you go from 100% occupied to 0 overnight. You have a 12-unit building, one person moves out, you're still north of 90% occupied. You can pay your bills, pay your mortgage, pay everything. That's why the economies of scale. The other part is it's easier to finance, and then the generational wealth. So what do I mean by the financing side? When you do residential real estate, that means anything technically single family up to 4 units, technically. You're dealing with residential financing, meaning the lender is looking at you personally, okay, not all the time, but most of the time, to substantiate whether or not you can pay the loan, pay the mortgage. When you get into commercial, which is 5 or more units, the bank is looking at the property. So as long as the property has financials to substantiate the loan, you get the money. As long as you're not a fraud, you're getting the money. They're going to throw it out the front door of the bank so you can go buy the property because they want to loan money. They just want to make sure it's a good financial deal. So the bank's going to back up your underwriting the same way you would, okay? So that's why it's easier to finance. And they're not looking at the same types of credits and background and searches and all the stuff that they're typically going to do on a residential financing deal. Commercial is looked at in a much more generous way. And then you get the generational wealth, something you can pass on to your kids, to your family, to relatives, to people, pass on to other things. Like, you want to pay off your investors. Let's say you started a deal with investors. Over time, you refinance them out of the deal. Now you own 100% of the deal. Well, you can pass that on. Maybe your kids want it. Maybe you want to do something else, right? Things that can go on. The generational wealth and the tax benefits that build from it are substantial. And that's why multifamily is the name of the game, okay? Over any other asset class. And I could have field days on this. You could talk about flex space. We're in storage facilities, and we also have mobile home parks. Okay, we understand that space as well. Similar, but different, multifamily. It's all rental property-based stuff. So kind of walk you through my story. If you don't know who I am, and you just saw some random guy online, my name is Justin Brennan. I'm a multifamily investor. Kind of grew up learning from my dad and my grandmother a bit into the real estate space. So I wasn't completely naive and novice to it. My grandmother was in apartment buildings as an old lady down in South Bay, San Diego. I think at her peak, she owned like 50, 60 units, but all on her own, 100% hers. And she'd drive around in her little S10 truck at 91 years of age, collecting rent. Okay, and this is all the way back in the 80s and 90s. And she passed on, but she did leave kind of a knowledge base, not so much money base, but a knowledge base for my dad. And my dad was really, I would say, our transitional character in our family. He was the one that made it big. He went from zero to hero. He had a really bad childhood and upbringing, right? Got, stepdad beat him up, and it's just a bad situation. Went off to Vietnam, came back, got into real estate brokerage world, hated it, then started developing and building homes in San Diego, and got pretty big. Started multiple companies, went through multiple cycles, became a multi-millionaire, and made it all the way through 4 different cycles until this beautiful time. Because we lost it all. I mean, it's about as lost as you can get. We lost it all. Not necessarily me, but my dad and my family. It was bad. And so I watched him go through all of that. Gnarly. But it also builds character, and it teaches you things not to do, again, and how to rebuild if you want to do that. Thankfully, I didn't go through any kind of crazy BKs or anything like that, but I watched my dad essentially go, right, from being this massive developer, worth millions of dollars, and then the bank's calling. I'll never forget this, by the way. It was April 8th, 2008, and a lot of eights. April 8th, 2008 at 8:30 something in the morning. My dad walks into my office. He sits down at my desk because I was working for him at that time. And he says the bank's just called and they're shutting down all the loans because we had a bunch of construction loans on projects that we were building. And I said, well, they can't do that. And he says, yeah, I know. I told them that too. But they didn't care. They said, sue us. They knew that everything was going down. So they had to cut their losses and let everybody, out to dry per se. And that started the tumble. Because when you have X millions in liabilities and you have only a certain amount of assets, you can imagine party's over. And so everybody that went through that, you remember how violent it was. But what it did teach me was a few things. Number one, don't ever over leverage. Okay, don't ever over leverage. Number two, I don't just like the build and sell game, right? I need cash flow and I need consistency. It doesn't have to be sexy, but I like things consistent. Right? I don't need massive 40, 50% returns, but you give me 10 to 15, 20% a year returns on my money, I'm cool. And I can sleep at night and stay under leverage so I can ride through tough markets, kind of like we're dealing with right now. Okay? This is like another mild version of 2008 in a different way, and I'll explain that. But 2008, so everybody kind of remembers that. Divorce, followed by trying to contend, single family rentals. I love it. Thanks for sharing, Bruce. Yeah, the wild time. But I also knew at that time that we had to buy property, right? We had to buy real estate. I knew that. And I went to a partner at that time that was not affected by what was going on. He was in the tech industry. And I said, Chris, here's the deal, man. I have all the sweat equity. I mean, I have the knowledge. I can go find deals. I can analyze them. I can put them together. I can run the show. I can roll in commissions because I was a broker at the time. I can do everything. I just don't have the capital to put in as a down payment. And I can't sign on the loans right now. I'm getting murdered. I need your help. So you're the capital, I'm the sweat, right? Let's go to work. And we went and we literally in 2010 got our first condo. $100,000 condo in Murrieta, California, right? Murrieta, California. Then from there, we built that up to about 20 units, all with duplexes and triplexes and fourplexes in the San Diego area. And we thought we'd made it, right? We had about 3.5 million bucks. We're cool. We made it big. We're retired, right? All the whole thing. And then right around this time, 2017, 2018, I started to be like, man, we're running out of our own money, but we want to still grow and scale. How do we do this? And I started running into these things online, maybe looking syndication, other people's money, buying apartments, like all these things, these terms that I had no idea about. So I went to a conference in 2018. So between 2018 and 2021, right, we took that and then we went and we actually bought our first out-of-state deal in 2018, 2019, and it was in Kansas City, Missouri, 27 unit, about $2 million. And then we raised about 800 grand from people around us. Okay, we got $1 million something odd loan and brought in about 900 grand in equity between ourselves. And we brought in around 60 something thousand, raised the rest from friends, family, people, about 7 people. And we bought that deal. That was our first one. Then we got a 31 unit, then a 50 unit. And then we started growing. And between 2021 and where we're at today, we currently have over 600 plus units and about 180 million bucks in assets today. And our goal, just so you know, is to get to 10,000 units. What's your goal? I mean, you may not even know what your goal is. You're just trying to learn how to do this. But I'm trying to walk you through, literally, guys, one condo, 600 plus units. Here's your timeline. We probably could have done it faster. But, you know, we got kind of stale in here for a little bit thinking we'd done great and just sit tight versus we should have scaled and grew back here, right? We did it here pretty quick. And then we're going now, but 10,000 units. But when you're buying apartments, you guys, there's really 5 aspects, okay? Which one of these, or few of them, type it in, right? Which ones are most, I guess, critical for you that you feel like, gosh, I need to master these. I don't have them down. In order for me to buy apartments, it's 5 pillars. It's 5 pillars. Just so everybody understands how the game of multifamily works. You don't do it alone. It happens through collaboration, partnerships, and community. Very few people can go out there and stroke a $5, $10, $20, $30 million check to go buy an apartment building on their own, right? There are some, but they're few and far between. Vast majority of these deals are getting done through collaboration and partnerships. Vast majority, almost all of them. Through syndication, as they call it, collaborating OPM, your money with other people's money, but you have to start somewhere. Okay, you have to start somewhere. Finding deals, and then the financing and capital tend to be the biggest ones. Analyzing, that's easy to teach, right? Once you go through that a few times, we have deal analyzers and all these things that you get. All that stuff is a part of it, but and we teach and review and look at things alongside everybody. It's awesome. But the analyzation part, you can learn pretty quickly. Finding deals is a bit of an art form. We're going to go over that here briefly. And then how you finance and capital, we're going to go over that as well. So when you're looking at these things in terms of, okay, in terms of the areas that you need to focus on, these are the 5 pillars. And what we're going to do tonight is we're going to focus on the main 3 that everybody gets most stuck on. These are important, right? But we're not going to focus on these tonight. We're going to focus on, for the sake of time, the top 3. Has anybody ever taught you this? The game of money. The game of money. And I'll briefly go through this. The game of money. This could literally be referenced to, because we're right after this election, okay? You have to understand how the money game is played in the United States of America, how capitalism is truly recycled, I would call it, and how the IRS works in conjunction with everything we're doing, and why this works, because this was explained to me. This is a game of money. You have creators and you have contributors. You have creators and you have contributors. Creators, business owners, entrepreneurs, investors in real estate, investors in businesses, investors, people that are out there creating products or services into the marketplace that are then consumed by the contributors, who tend to be W-2 employees earning a paycheck, working for the man inside the rat race. The money leaves the pocketbooks of the contributors and it moves over to the pocketbooks of the creators. And then they take it, they create more products and services, they sell that stuff back over here. It's a nice big game of money. The IRS, okay, loves the creators. The reason they love them is because they move a lot of money. They create. They move money. They move capital, capitalism. They move it. So because of that, the IRS gives them most of the tax breaks. Over here, you're very limited in your tax breaks because you're not moving enough money. So if you want to get the true benefits of financial freedom, tax benefits, write-offs, keep more of your money in your pocket and not give it, you get the most benefits here. The IRS is going to give it to you because they want you to grow businesses and wealth and everything and move a lot of money in society, because eventually they're going to get theirs. It's just a matter of time, and they want a piece of a bigger pie. Does that make sense? That's why they're doing it. It's not because they really truly love creators. They just want them to make more money so they can take more of it later. That they get their piece of the pie. It's just down the road, it's a piece of a much bigger pie. So that's how that game's work. That is the game of money. That is the game of money. So I'm going to throw this up. If you have never seen this before, this is really helpful for everybody in here tonight. As you're coming into the end of the year and you're trying to maybe you're struggling with finding motivation. Maybe you're struggling with purpose and drive and what's getting you going. Maybe you're, like you said, you're making good money, but it's you feel a little bit lost. What is your direction? This is a self-identity audit that you can do. And we're going to play a piece of it right now. I'm going to put this up. I want to know, okay? I want to know, what are your mountains? And I want you to pick 3 or 4. And I'm going to walk you through how this game works, okay? And I want, when you pick these things, what gets you burning in your belly? Super excited, right? Super excited about life, getting up in the morning, moving, making things happen. Is it sports and culture? Is it family? Family could be philanthropy too, not just personal family. It could be giving back, helping others. Media, government, business, education, religion, right? If you went out to a bunch of people last night, they'd say government, politics, right? For other people, it's family, media, business, education, things that get them driven and excited, because money's going to get you going, but it's not going to keep you there. The minute you hit a roadblock or any kind of hiccup in your personal life or anything going on financially, you're going to quiver. If you don't have the rock or some of the stuff settled in, what are your mountains, right? What are your mountains? What are your pillars that lock you in place and get you excited every day? Okay? Because the money is great, but you hit a roadblock, you're going to literally crack. If you don't have these and a few of them in place to kind of go back to your core value and say, okay, I know why I'm doing this. I know why I'm doing this. Okay? I know why I'm doing this. Beautiful. Watching that come in, I'm going to share that with everybody. Awesome. So family's a big one, as you can imagine, right? If you don't have people around you that you love, people that love you, and this is not, like I said, not just your personal family, it's also philanthropy, giving back, helping others, right? Because that's a key component to it. It's not just the family. So it comes in a lot of different fashions and forms. A lot of different fashions and forms. So you got family, then you have business. You have to have a successful business that drives income, that you can take that income, repurpose it to multiple things. Maybe it's educating people, helping people, giving back. Maybe it's into government, sports, culture, maybe religion, other things that you're super passionate about. I mean, I see that in here too, right? Religion's a pretty good one. Business is important. Those are all important ones to me. Business, family, education, and media. Those are all big ones to me that get me excited every day. It's why we're even here tonight, right? The education side. The education side, because now we can take, okay? For me, it looks like this. You create successful business. Then it can come over here, right? You can help educate and create a community of well-trained investors around the country, okay? Then it comes over here and you leverage that with media to then be able to give back, not just to my personal family, for us, my kids and everybody, but also philanthropy, right? We're big on Tunnels to Towers. I don't know if you're familiar with that organization, or the SEAL Future Foundation that helps Navy SEALs transition, team guys transition from team life into real civilian life. We even do the Rady Children's Hospital. And then we also do Wounded Warrior Project and a couple other ones about veterans and stuff. We're really connected with the military families. So these are all things that are really, really passionate. For me, what's passionate for you? And I want you to keep those in your mind as you go through this tonight and you're thinking about doing this. That's what's going to drive you, okay? That's what's going to drive you. I'm not even a 1%er, but I'm doing that. So is it that you're saying that that those mountains are controlled by them, or that the 1%ers have a majority of it? Because anybody can get there. See, most people think that millionaires and billionaires are all trust fund babies. But did you know that over 80% of all the millionaires in the United States of America are self-made? Did you know that? I don't know. Most people don't. They think that somehow they're given the money. It's a very, very small percentage that's actually trust fund babies where it transitions. Most generational wealth, as we know it, fails after the third generation, right? What do they say? The first generation earns it, second generation spends it, third generation bye-bye or something like that. I know you guys have heard those terms before. So, yes. Yeah, I mean, you have some major families that owned a lot of things in the world, but, there's plenty of wealth. There's an abundance, right? I mean, having an abundant mindset versus a scarcity mindset is critically important, right? There's abundance of money. There's abundance of wealth. There's an abundance of resources. It's just, how are you going to go get yours? And by doing that, how are you giving back, helping others, leaving a legacy in that path? Because what you'd probably find out is that by giving back, helping others, right, you create abundance, right? Because the law of reciprocity does its work. Right? It will pay you back in multitude, usually 10 times over. So by giving and helping others and having that mindset of abundance and giving, watch. The law of reciprocity pays itself forward. So multifamily school. You probably ask yourself, why are we here tonight? Well, because of this. We created this about 2+ years ago as a community of investors of multifamily around the country who've come together, collaborating, doing deals together, learning, right? Some of them getting mentored, some of them just in the programs in general, but they're learning and doing deals and then do bigger deals together. And so Multifamily School is the community that was kind of put together to do that. And that's kind of why you're even here tonight, is to kind of learn about, okay, how do I do this? And if I wanted to, how can I get into a community that's doing it right now? And how can I execute and pull this off in the next several months going into 2025? Okay. Because these are people and testimonials and things going on around the country of people that are in the community now, have gone through it already and are coming through it currently. Both men and women, young and old, doesn't really matter. I mean, we have 20-year-olds in it. We have a 60-year-old in it. It doesn't even matter. 65 Thomas over here, right? It doesn't really matter. It just depends on where you're at, where you want to go, and what you want to do, and how can we help you get there and be a guide through that process. Awesome. So we talked about the 5 pillars. So we're going to get into finding deals. But how do you make money with multifamily? How do you make money with multifamily? Do you know? Remember I said in the beginning, you make money in 5 to 8 different ways, 5 to 8 different times. Acquisition fees, and I'll get into these in a minute. Acquisition fee is something that's earned in the beginning of the deal for putting it together. Very standard, 2 to 3% of the purchase price. Asset management fee is a recurring fee every month, 1 to 2% of the revenue. Then you're going to get a percentage of the cash flow for owning the deal and putting it together, a percentage of the profits that's going to come out multiple times throughout owning the deal. You're also going to get all the tax write-offs, 30 to 40% of the tax write-offs. And if you're doing renovation on the property to improve its value, construction management fee paid monthly. Then when you go sell the property down the road, you can also get what's called a disposition fee going out the door. And then on top of that, you can get what's called a finder's fee for even finding the deal. Because there's a lot of value in finding deals. If you're great at finding deals, you can get paid just to do that. Okay? Just to do that. So those are the 5 to 8 different ways you can make money in multifamily. There are not too many asset classes you can pull that off in. A flip, you go flip a house, what do? You buy it, you renovate it, you get your profit at the end, one time. And on top of that, you're not getting any tax benefits because you're doing short-term tax gains. So you're getting hammered within a 12-month window. So you're literally, flipping's great. We still flip, but just understand the purpose of that game. The game of flipping is to flip the house, earn the short-term money, go position it into long-term assets to get the benefits long-term and grow the generational wealth. Leverage the flip to get to the long-term. That's how you do flipping correctly, or wholesaling. However you want to do that game, you do it in conjunction with this. And that's how you become a millionaire, okay? And I love how you said you're in a community now, you just need the essentials of finding deals. Well, we can go through some basic essentials. The thing is like there's information and then there's nuance of how to execute. And then there's hand-holding on how to actually do it, because there's nuance in all of this, right? There's always the little, the great, you can read it in a book, cool. I can watch a YouTube video, cool. But when you get into the nitty-gritty nuance, how do you actually physically do it in the moment and walk through all the nuance that happens in that process, because that's how you get over these little hurdles that people get into. So finding deals. There are two ways to find deals. Two ways to find deals. Direct to the broker or direct to the seller. Now, both work. We do both, but we're at a point where we can do both because we have the time and the money to do number two, which is direct to seller. I'm going to presume, everybody in here, most people in here, based on what you told me, you have a job, you have a career, you're doing stuff 9 to 5. So you do have limited time, right? Because you're at work, you come home, maybe you have family time, kids go to bed, you got family, wife, kids, whatever it may be. And then you have a window of time once all that happens before you go to bed. And in that window of time is how you're going to start this process of learning, finding, analyzing, putting deals together. It's no different than I did. Okay. I was in real estate sales, doing luxury real estate sales in San Diego for 10 years. I knew I wanted to get into this game of multifamily and get out of the rat race of the traditional transactional real estate. So what did I do? 10 hours a day, selling houses, making great money, right? 3, 4, 5, 600,000 a year. Good money, good money. But I wanted big money. And I needed to do that. I had to take a step back to go 3 steps forward. So what did I do? 10 hours a day at work, come home, got family time, kids, wife, all that stuff going on. Once that's in bed around 8, 8:30 at night, I'm on the computer looking for deals, finding things, putting them together, learning, underwriting, analyzing, doing all this stuff for a couple hours a night until I got to the point where our first deal happened. Kansas City, Missouri, 27 units. That was in 2018, 2019. And that started the programming. And then 3 years later, boom, I was out of residential sales altogether. By 2021, 2022, full-time multifamily. And that's where I'm at today. But I had to make that commitment to myself, and I had to go. I had to get to the edge of the cliff, jump off, and allow the how to show up. Right? You're not going to have all the answers. There's going to be risk. Welcome to life. And you all know this. I'm not telling you anything you don't already know. Okay? Anything you don't already know. So, direct to brokers. How does this game work direct to brokers? Let me walk you through an exact case study so you understand exactly how you do this game, okay? In the broker world, there is pre-market and there is on the market. Pre-market and on the market. Let me give you a great example. Right now, literally, I have a deal in Kansas City that we are pre-marketing. We're not even on the market yet, but the broker I've been talking to for a couple months, they finally got me to raise my hand and say, yes, we'll consider selling the property. So they've done a broker opinion of value. They've gotten the marketing together. We're ready to go. We have an idea. We're going to start teasing that property out to the pre-market via the broker's database of people that they know. He's getting ready to do it. Literally, it happened this afternoon. It's a perfect example. So if you're in the database, in the pre-market phase, that's how you get access to them. So how do you do that? How do you go from not knowing any brokers to getting your first deals pre-market? Let me show you. Okay, let me show you. So this is a deal that I found online before we even came on here, okay? And you can use any of these websites. I don't care if it's CoStar, if it's LoopNet. I don't care what it is. I don't care what it is. It could be any of these, guys, any of these. But this is the one in particular. I'm going to show it one time. There you go. Okay, so this one right here is in Tennessee. Is it in Tennessee? Yeah, Tennessee. This is a 23-unit deal, asking $1.4 million. Good little property, been on the market 51 days. So how would I start the process if I wanted to go into Tennessee and I said, this is a market I want to go into? How do I start the process of finding deals? Here's how it goes. Ring, ring, ring. Hey, Austin, how you doing? This is Justin Brennan with the Brennan Pulley Group. Hey, I'm looking at your deal over here, this 23-unit deal on Melrose Court, the apartments. Yeah, looks like you guys have been on market a little over a month now. How's the activity? Okay. Perfect. Do you have any active offers on the property currently or just waiting for offers to come in? Okay. So you did have one offer, it just didn't work out. Are you guys doing like tour showings? You taking offers as they come in, or is there a call for an offer date, like a deadline date? Okay, so you're taking offers as they come in, you're doing tours one by one or group. Okay, great. Look, I'm going to be out there in Tennessee in about a week. I'd love to tour this property. And I'm going to be seeing a few others while I'm out there. Can I go ahead and schedule a tour with you now? And I may ask you a few other questions and get to know you a little bit, et cetera, et cetera. But at the end of the day, that's how you're starting the process, because whether or not this deal makes sense is irrelevant. It could be the most overpriced deal on planet Earth. That's not the point. The point is Austin's a deal maker. He has other listings. He has pre-market stuff. If I get access to his on-market stuff, I guarantee I can get access to his pre-market stuff because he's a good broker in the market and I can build a little rapport. Does that make sense? Because that is step one. And once you begin to get that flow coming in your inbox of pre-market deals, that is how you're going to start to see the deals that make sense. Because if you were to take, literally, if you were to take 100 deals, okay, 100 deals, 60% are going to go pre-market. So 60 of those 100 will sell before they ever get to these websites. The only reason they're ever getting to these websites is because they're overpriced and they didn't sell here. Because this is why many people struggle, because they don't understand how the game works. They go onto these websites and they get frustrated. They're like, none of these properties make sense. Excuse my language. No shit. No shit, they don't make sense. They don't make sense because they're not designed to make sense. Right? They're overpriced, which is why they're on the website. They didn't sell here. So the broker took them to market here, hoping to get some dumbass to pay for them. But that's how it works. So if you want the real game, that's how the game works. The key is to pick them up here, but you leverage this to get to that. Leverage the on to get to the off. And that is how you'll do it. That is how you leverage the broker game. Now there's the direct to seller game. That's another conversation. But I don't think anybody on this call tonight has the time and the money to go invest into direct to seller marketing. Because you're going to spend thousands, unless you have 10 to 20,000 a month to put towards marketing, okay? And enormous time to be on the phone, door knocking, sending mailers, and doing all this stuff, then you shouldn't do that as your method to start. Direct to broker. Because for every mailer you're sending out, the brokers are sending 5. For every phone call you're making, the brokers are calling me 5 times. For everything you think you can do, they're doing it 10x. So you leverage the brokers who are doing the deals to get access to their pre-market deals before they get to the web. And that is how you'll find your deals that when you look at them, you'll be like, holy crap, this makes some sense. Let's make an offer. And that is how that game works. And so that is finding deals. Finding deals. Yes, they do have an ABC list before they put it on the market. You're 100% right. 100% right. Building that little bit of rapport is how the game has worked. Okay, but you have to start. But here's the key. This is also why I'm not sitting here telling you, go after 50 plus unit deals, everybody. Go big. Because you don't have a chance in hell of getting that. If you have not done a multifamily deal and you don't have a partner who's done a multifamily deal at that space or larger, you literally have a better chance at breaking into the White House with Joe Biden tonight versus that. Okay? So you need to focus in this space. 10 units to 30 for your first deal or 2. Why is that? Because the brokers will call you back. Mr. Austin will call me back. He's not a big time broker. He's a little mom and pop broker. The seller will respond. The lenders will get back to me and give me financing because they're dealing with more mom and pops in this space. You can begin to start. That's how you get going. Start in a space that makes sense, graduate up, and then you can start doing this. 100 plus unit deals. But you got to learn to, what they say, walk before you run. We all know that saying, but you got to know that. Listen, there's a lot of nuance to this. What to say, how to say it, how to approach, not to approach, things to do, right? And we provide all this stuff inside the community and everything that we do. And if people want mentorships, we can do that too. But yes, there's a lot of nuance to it, but that's why people get help, right? And don't just run off and try and do it themselves, right? There is benefits to that. I'm mentored. I've been mentored for almost 15 years now. Thank goodness. But that is how you're finding deals. So what makes up a good deal? Because I get this asked a lot too. What makes up a good deal? Simply put, you're going to look at these 3 metrics. Now, there's deal analyzers that we have, and we're going to give you actually a multifamily toolkit tonight. Stay towards the end. I'm going to give you a free multifamily toolkit you can get into and have it all, right? So 14 to 20% annual return on your money. So if you want to attract money into your deals, the deal better produce a 14 to 20% annual return or more in order to attract money. Otherwise, people will put their money in stocks, bonds, other investment vehicles, and won't take the medium level risk for real estate. Okay. Like if I came to everybody tonight and I said, hey, I have this great 10 unit building in Tennessee, it produces 8% return on your money, right? You'd be like, I might as well just stick it in the stock market, and the S&P 500 can give me 8.2% historically, and I'll have more liquidity and less risk. So there has to be risk-adjusted returns. Cash-on-cash return of 6 to 10% or more. Equity multiple, meaning if I give you 100 grand, how much am I getting back? If it's 1.8, if I give you 100 grand, I'm getting 180,000 back. It needs to be at 1.8 or more. And those are your high-end metrics. Once again, there's nuance to this. We have deal analyzers that give you all this. You just plug and play. But these are the types of metrics that you're looking for from a high level when you're analyzing a deal. Okay, when you're analyzing a deal. So, cool. So that's what makes up a good deal. At that point, if it check, and it needs to check all three, by the way, all three, then you'd get into, okay, let's analyze this sucker and really say, hey, does it make some sense? So when you're analyzing any kind of commercial real estate, rental income property, that beautiful number called the net operating income, right? NOI, net operating income, and the power of it. To give you an example, for every $1,000 a month that I can increase my net operating income, I add over $220,000 in my pocket of value to the building. Let me repeat that. For every $1,000 a month, I can increase the bottom line of that building. I add $220,000 in value to my pocketbook. That is the power of net operating income. You do not get that anywhere else. You can have literally two buildings side by side. One is being operated like crap. One is being operated well. Identical buildings, identical locations, identical everything. The difference is operations. One has a good NOI, one has a crappy NOI. This one has an NOI of $1,000 more per month. It's worth $220,000 more in value. It's that simple. It's all financials. Okay, it's all financials. Value add deals. There you go. I love that term. That was from Jim. Value add deals. Yes, it is all about adding value. I agree. So that is the analyzing deals portion. So then the question comes into raising money, right? How do you raise money? Does anybody feel like they get caught up with the raising money portion, and why? I'd love to hear like why everybody has such a roadblock with raising money. It's typically because you haven't done it, and then you don't have the processes in place of how to actually do it and the tools in order to do it. So that's how you get to it, Ann. I'm going to walk this through this. So gross income on the building, how much rent? Pick out economic loss. That includes vacancy, loss to lease, bad debt, concessions. So that is what economic loss is. People, if you've never heard of that term, that's why you're here tonight. You're getting real deal stuff. Economic loss, that includes these four items: vacancy, physical vacancy, loss to lease. That's the difference between market rent and actual rent. Bad debt, people don't pay their rent sometimes. Concessions, maybe you have to give a free month's rent to get people in there. Okay, that all is going to add up to a certain number. Then you're going to add in some other income. This could be pet rent, parking income, other things like that. That gets you to a number called effective gross income, EGI. Then you're going to take out your operating expenses. This is repairs and maintenance, property taxes, insurance, all that stuff, general administrative, everything out of there operating expense wise. And then you get to your beautiful number, net operating income. And that's before you take out your mortgage payment, and before the mortgage payment. Okay. So that is the formula. And it doesn't matter whether it's a 2-unit building, whether you're getting a duplex, or it's a 100+ unit building. It's literally going to follow the exact same formula. There's just a lot more line items in it. Okay. Great question. Sorry I didn't show you that before. And then the value of the building, yeah, it was hung up in the numbers there. I knew it was somewhere. The value of the building is the net operating income over what's called a cap rate. So a capitalization rate is a market rate for capitalization, like speed of money. It's typically a cash-on-cash return without leverage. I don't want to get into the crazy nuance tonight. This is all the stuff you need to learn. But when you're talking about value, how you value a building, it's the net operating income, that number divided by a cap rate, which is typically right now, depending on where you're at in the US, you're somewhere between probably a 5 to a 7-ish, somewhere in there. Cap rates have gone up, right? Cap rates have gone up, which means values have dropped, right? And we're in kind of a tough market right now. Like it's a good market, great for buying. But if you're a seller, you don't sell unless you have bought that property a long time ago, or you really have to sell, right? That's the only reason you're selling right now is you bought that property and you have your profits from a long time ago, or you really have to sell. Okay. But that is how you analyze a deal. So let's talk about raising the money. Okay, raising the money. So you need a deal that makes sense. So we just talked about what makes a deal make sense, right? Those three different metrics, right? Annual return, right? IRR, cash on cash, and equity multiple. A deal that makes financial sense. 14 to 20%, 6 to 10% on cash, 1.8 equity or more. If it hits these metrics, boom, you have a deal that makes financial sense. Then you go to number 2. You need a good pitch deck. Does anybody know what a pitch deck is? If you've seen a pitch deck for a property, for a real estate asset, whatever it may be, it's something that explains what the property is, what are the returns, how much money you're putting in, when you get it out, gives you pretty much 95% of all of your questions. If you were an investor, it answers them for you. And then you need a good process. You need to know the process of raising money, right? Legal process, financial process, logistics operations, some software stuff like that. Like little processes to how to raise money. And then you can do it. My first deal that we did to raise money was just under $900,000. Now, most people are like, oh, it seems like a lot of money. And it did to me. I was scared to death. I'd never done it before, right? But we did that with 7 people. We raised that money with 7 people. I didn't know if we were going to be able to do it. But you know what I found out very quick? If I have a deal that makes good financial sense, the money will find it. The money will find it. It always will. You just need to be resourceful. Remember, it's never a lack of resources. It's always a lack of resourcefulness on your end. It's never a lack of resources. It's always a lack of resourcefulness on your end. So be resourceful, and this won't be a problem. Don't be resourceful, and this will suck. But we help you be resourceful. We help you be resourceful. You need to learn that. Very important mindset in resourcefulness. So that is how you're raising money. Deal that makes sense, good pitch deck, and a process for it. So let me give you an example deal. Okay, this was that one that I showed you earlier, right? This is that 23 unit. Now they're asking $1.4 million, right? They're asking $1.4 million. But for the sake of tonight, we're going to think we got a deal. We got it at $1.3 million price. We're putting in $250,000 to renovate the property and improve it. $100,000 in closing costs to close the deal. Okay. So we're going to be all in at about $1.65 million. That's our total cost in the deal. So how do we break that deal up? Well, we're going to go out and get a 70% loan. That's about $1.2 million. That loan is easier to get than a $300,000 house loan. Remember why? Financial, it's commercial. They look at the property's financials, not yours. That's why it's easy to get that. Then you got to bring in the down payment. It's $450,000. Now you may be saying to me, oh, Justin, I don't have $450,000. And my response is, I understand that. Neither did I when I got started. But what I could do is I could bring in 10%. So I brought in 10%, $45,000. Okay. And for that, you get about 30% of the deal. I'm going to show you that in a minute. You're going to raise, or through creative financing, friends and family, seller financing, private lenders. There's other methods for this money here where that comes in. That's the OPM, other people's money. That could be other people's money, seller financing, private money, all the above. Don't worry about that. The money will find itself, okay? Everybody gets kind of caught in this conundrum of, oh my gosh, I need to go raise all the money before I go find deals. No, go get a deal, lock it up. If it makes financial sense, the money will find you. It always has, it always will. Just learn how to be resourceful, find good deals, have a good process, and you'll execute. And we can show you how to do that. That's what we do inside the community all the time. But you got to have the processes and deals, and you got to know the nuance of how to do this. And you become a millionaire. I mean, it's not that hard to do. You just have to understand how this works, okay? Here's the cool thing. If I brought in $45,000, the 10%, remember how I told you get paid 5 to 8 different ways? Well, the first way is an acquisition fee, 3%. On that, okay, $1.3 million, $26,000. So I'm technically only out of pocket $19,000. Are you following me? I brought in 45. I got a check literally at the close of escrow. This money is inside my closing costs. I literally, Peter to pay Paul, got that money out to close of escrow. I'm out of pocket 19 grand. And now I have control of a 23 unit, multi-million-dollar asset. Okay. This is how it works. This is how it works. And we can show you. But that's how you're going to break down a basic 23 unit deal. Now I'm going to show you the structure of that, right? The legal structure of it. And stick in with me. We're going to go a little bit over time here, but it's well worth your time. And you guys are getting some nitty gritty tonight, which is great. Okay. So how would you structure this deal? From a legal perspective, how would you structure it? You're going to have an LLC, single asset entity. Call it the address name, 1234 East Street LLC. Okay. It's going to have ownership of the property. That is you're going to have an ownership here, right? So the general partner and limited partner. Over here, it's 30%. Over here, it's 70%. And that's the ownership. Now, remember, I brought in 10% of the money. My investors are bringing in 90% of the money. They're getting 70% of the deal. I'm bringing in 10% of the money. I'm getting 30% of the deal. Now, here's the really cool part. Because I am the general partner who put the deal together, worked hard, made it happen, found the deal, analyzed it, raising the money, doing all the tasks, doing all the stuff, right? You get paid handsomely. You're not in this to work for free. You're in this to do well, make a lot of money, help your family out. Remember, do all the things you really want to do: media, business, religion, government, sports and culture, family, all those things that are really, really passionate in your belly, but you got to have the business and the money to do it. And if you work your ass off and you do well and you produce well, you should get paid handsomely. So as a general partner, these are all the ways I now get paid. Acquisition fee, asset management fee, 30% of the cash flow, 30% of the profits, 8% preferred return. Now I get my percent of the 70% over here because my money, that 45 grand that I brought in, it's literally invested alongside my investors here. I am my own limited partner in my own deal. My money gets a piece of this over here, and I get this 30% on top of that. It's like a promote, they call it, like a bonus. They give it like a tip at a restaurant, and you get great service as a stewardess or whatever, right? Server. You get a 30% tip for doing a great job, and that's why you do it. And you make all this money. So then how do you break that down? People say, well, how? Okay, great. I get paid 5 to 8 different ways. Well, how? When does that happen? Show me a timeline. Cool. When you purchase the property, this is when your acquisition fee comes out. Every month, you're going to get cash flow. Now you have year one, you're going to have some more cash flow and stuff. Meanwhile, you're getting profits and other things coming out. Then right around year two, you can do a refinance of that property. Value's gone up. You can pull cash out. You can get a liquidation event. Then you hold it for a few more years. All the meanwhile, you're getting all this cash flow, distributions, profits, everything happening along the road. So you're getting paid every month. You're getting paid some big pops here and there, 5 to 8 different ways throughout the life cycle of the deal. And that's how you make the money in multifamily. Not to mention the tax write-offs. I have not paid income tax in now 8 years. And this year I ain't paying them again. And it's not because I don't make money. It's just because we leverage real estate to have enough write-offs for bonus depreciation to offset for tax returns. And it's that simple. It's in the tax code. Why? Because I'm a creator and the IRS loves me. Remember? I mean, that's the truth. That's how the game works. And you have to understand that game so that way you can get into that game if you want. And we can help. The rates rise. You have fixed interest rates. But I can give you a situation right now where people had variable rate, right? And then interest rates went up and they've lost their ass. Remember I talked in the very beginning about not over leveraging? So fixed rate debt is the best way to go ideally. There are scenarios where variable rate debt makes sense, but most of these deals are fixed rate debt. So rates can rise and go up and down unless you get into a situation where they call what's called a negative yield curve, right? Where you get in a 4% rate and then the Fed raises rates 11 times in 9 months like they did in 2022, on, and then your rates go from 4.25 to 9.5, more than double. So then you wonder why we have a looming 2008 quietly behind the scenes in the commercial real estate industry. It's an enormous opportunity, but it's happening right now, quietly behind the scenes. It's not hitting CNBC. It's not on your newspapers and your networks, guys. This is all happening behind the scenes, but great time to buy because there's turmoil in the capital markets a bit, in the commercial space a bit, both office and multifamily, getting hammered. Perfect time to buy this year, next year into 2026. And then you're going to start to see things skyrocket again. So stand by. But the game is now. But that's kind of your timeline for cash flows and money and everything you're making. And you're making the money in multiple different ways throughout the life cycle of the ownership. So I told you that we talk about closings. We're not going to touch on that. A lot on that. Managing, self-management, property management. We're not going to talk on that. I do want to give you an actual case study. So this, remember I talked about that first deal in Kansas City? This was our second deal in Kansas City. 31 units. I had $18,000 of my own money physically out of pocket in this deal. Let me explain how it went down. So we bought the deal for $1,525,000. We put about $400,000 in renovation dollars to it. Closing costs of $225,000. We were all in at about 2.1 and change, $1 million. We went out and got a loan for $1,500,000, super easy to get, 70% loan. We brought in around $645,000. I brought in 10%. Remember, 10%, 64 grand. Now here's the cool thing. I got an acquisition fee of 45 grand. Peter to pay Paul. So I was actually only out of pocket $18K. 90% of the money was brought in from 8 different investors into the deal. That was the breakdown financially. So let's talk about like what I got. Like from a money perspective, what did I get? And what happened with the deal? So that 31 unit deal, we renovated it. We took the value from $1,525,000 up to over $3.6 million. Now, not every deal is like this. This was a home run. Okay, most deals, you take it from maybe that at $1 million, 2.5. We hit a home run on this one. So that allowed us to do 100% cash out in 24 months. So 24 months later, we did a refinance on the property, pulled out all of our money, and then some on top of that. And all of that's tax-free, by the way. It allows us to go buy other things. Paid off our investors. I get an asset management fee every month of 1%. I get 40% of all the cash flow and profits coming out of that deal every month. $2,000 a month for 5 years, about 120 grand. Profits from the sale, about 470,000. So I made about $590,000 on an $18,000 out-of-pocket investment. I mean, and that's not abnormal, guys. The only abnormality is the price point that we were able to take it to. But the process, very, very normal. Very, very normal. And anybody that's in this space, you totally get this. Okay? If you don't understand this, not a problem. That's why you're here learning. And if you want to learn more, there's community, there's learning, there's opportunities for that. And if you want to start getting into this for yourself, because it sounds like there's people very interested in it, we can certainly help you out if that's something you're interested in. Okay? So that's what you get. So I ask you this. I mean, is a community something that is of interest to anybody in here? If you got into something where you could talk to other people that are in, learn from them, do financing together, raise capital together, find deals together, leverage together, opportunities together, is that of use, right? Where people are collaborating and partnering around the country, well-trained investors, some at different stages, but growing and getting into their first deal, their 5th deal, their 10th deal, and collaborating. Like, is that of value? Is that something that anybody in here would have interest in? Okay. Yeah, and I would agree. I mean, that's how I got started. Because trying to do it alone, you can. Like, you can. But you're peeing into the wind. Because once I finally understood, guys, we did not get to 685 plus units writing the checks ourselves, or even trying to do all the money ourselves and raise it all ourselves. We did it. Like, once you get to a certain point where you're going after a 100, 200 plus unit deal, that's a $25 to $45 million deal, and you're raising $12 to $20 million in equity, you're not doing that alone, and you're certainly not stroking those checks alone. So you have co-general partnerships. You'll have people collaborate and co-general partner a deal because they can't take it down alone, or they need to leverage each other's benefits. Some people are good at finding deals. Some people are good at raising capital. Some people are better at this, better at that. Some people are good at construction and operations. Great. Collaboration. That's how you grow. That's how you scale. That's how you get to 10,000 units, 685, where you want to go to 10, 15, 20, 100. You do not get there alone. It means very, very rare that you'll get there alone. Very, very rare. Okay. So mentorship community. So we have that. That is the multifamily school. And listen, it's not for everybody. It's not for everybody, but it sounds like there's some interest in it. 5 or more investors make you go from partnerships to syndication. Technically, Jim, just so you understand this, and I had to learn this from our securities attorney, mind you. Anytime you are raising money from anyone that you don't know personally, you're syndicating. Just so you know, from an SEC standpoint, right? Anytime you're raising money from anyone that you don't know personally, it's technically syndication. Now, most people, you're right, don't usually use the full form documents and the whole securities attorney and PPM docs and all that other stuff until you get to a certain threshold. So you're right on that. But I'm just telling you from a legal perspective, the correct one. If you talk to an attorney, right, they're going to tell you. So just so you know that. But you're right and you're wrong on that. But it's not, doesn't matter. So if you wanted a mentorship community, so we have one, the multifamily school. So people ask, like, what is it? It's not for everybody, but if you want some interest in it, so the mentorship community, get lifetime access, right? So it doesn't have a sunset date. Live weekly coaching. The key is that it's with me, right? So we're doing a one to few approach, a small group environment of 5 to 8 other investors similar to you that are coming in. I'm teaching it. Because the reason I'm teaching it is because I need people, it's somewhat complex, right? It's multifamily. So having people that don't know what they're doing or haven't done deals or can't explain nuance or can't walk you through scenarios, it's pointless, right? No one gets involved in stuff like that. You're going to feel like you're wasting your time. So that's me. Plus, remember where I want to go. Collaboration, partnerships, community to partner on financing, asking Q&A. You get a success coach. It's either going to be Zach or Brian, but you'll get a success coach assigned to you inside the community. Because along with them and me, we're going to be tag teaming to make sure you get to where you want to go. All the resources and tools. Like we have a treasure trove library of literally every single thing you will ever need to go buy apartments for the rest of your human existence. I'm serious. I'm talking multiple deal analyzers, checklists, due diligence checklists, your 90-page ebook guide, your pitch decks, your legal documents, samples of legal documents. I mean, literally everything. Letters of intent to write offers, on and on and on and on and on. It is a library that is a treasure trove that you get access to for lifetime, okay? And then we're going to help assist. Okay, we're going to help assist and guide you. And listen, how do you find the deals? How do you analyze them? How do you fund them and finance them, right? The closing and the managing. And when I talk about funding, cool thing we did, and this was by request from a lot of the people in the community. They said, Justin, we love that you're teaching how to go find the lenders and raise the money and all that stuff. That's great. But what if you could put in some of the lenders that you've used and you would recommend into the system and they could fund the deals for us right through the system? And I said, that's a great idea. That's a great idea. So we did that. We put 3 lenders in the back end of our system that when you come in, not only are you submitting the deals to us so we can help you review them, but you're also submitting the deals if you want them funded. And you can do it all right in the back end. You don't have to, but it's there to remove roadblocks and make things easy for you. Completely up to you. And then showing you how to close the deals. And then once you close them and own them, how do you manage these things? Do you self-manage? Do you third-party manage? How do you hire them? Questions to ask, things to do, all the nuance, right? That is the A to Z and assisting you with that entire process of doing that. So, sound interesting? Cool. So I kind of put this in there. So you kind of know what it is. Obviously, no, the program is not free. I mean, we have free stuff that you can do, but if you want this community and you want to take this leap and you want to do this stuff together, guys, this is how you can do it. And like I said, it's not for everybody, but if you want it, it's all here. Tremendous value. I went through it all. And just so you want to know what it is, obviously, it's that value is almost a $70,000 value. No, you're not paying that. And everybody that uses it, so just so you know, the actual price of this thing is $8,800. $8,800. But for the people on the webinar, what we do, especially if you're doing a paid, it's $7,800. We actually knock $1,000 off for you. I try and be upfront because I don't want people surprised, but I can tell you that the value is unbelievable. And everything that we give you inside of it is unbelievable. So if you have interest, don't worry about the money for a minute, okay? Like literally, don't worry about the money for a minute. Make sure that it's the right fit for you first. And if you're interested in mentorship, and this is something you truly want to explore, and you want to get to where you want to go in the next 90 days, right? You can take as long as you want. Once again, lifetime access to the program and everything you're doing, we're here for you. But we want to try and push you along, and we give you nice checklists, action guides, success coaches, everything ready to rock. And we will guide you. And if you want to be pushed, we'll push you. But don't worry about the money. Find out if it's the right fit first. Set up the informational call, but I want you to kind of just know what you're dealing with, so there's no surprises and people are like, oh, I didn't know. Because yeah, there's a cost to it. But I can tell you it's worth its weight in gold. And everybody that's in it loves it and they're growing. And our success rate's off the chart, right? For everybody that comes in, because people ask me that, they're like, what's your success rate? I said, well, there's 2 success rates. I said, for people that come in and engage and actually do the processes, it's 100% because they actually execute. But obviously I can't get people out of bed. I can't force people. I wish I could. Like, I wish I could get people and force them out of bed and be like literally right next to their nightstand and say, get your ass out of bed. We're going to do this. If I could do that, everybody would be millionaires, but you can't, right? You can't teach motivation. I can teach you everything else. I can guide you, but I can't teach you motivation. So that's why you can't have a 100% success rate because you can't teach everybody to be motivated. All right? Self-manage, any other things in there? So thanks for, once again, if anybody has, and you asked a question, I'm going to answer it right now because I want to open it up to Q&A. And once again, if you have interest, set the money aside for a minute, guys. You're at the edge of the cliff, right? Sometimes you have to jump and allow the how to show up. Don't worry about the money. Make sure that it's the right fit for you first. And then if it is, great. We can figure the money part out, right? We can figure the money part out. But what I want you to do is believe in the program first, right? Believe in it first. Because with that, like I said, the weekly coaching sessions with me, personal success coach assigned to you, lifetime access to all the tools, the systems, the community resources, everything, 90-day action plan and guide. You get all the lessons in the back end of your portal. They're all, everybody has video lessons, but we're not selling video lessons because anybody can give you video lessons. What you're getting is hand-holding, an intimate experience. You're learning, guiding, being mentored, and handheld through the entire process, A to Z, in buying apartment buildings. That's what it's there for. You get the document library, the opportunity to partner with us on deals. We love to partner. That's why we created the community, so everybody can partner and collaborate on bigger deals. Because once you do your first or second, what do you think you're going to want to do? Now you're not going to want to do a 10 to 30 unit. You're going to want to do a 50, 80, 100 plus. So what do you think we can do together? Partner. And I said, we're going to assist you in finding, analyzing, financing, closing, and managing the deals, access to our systems and vendors. So you're going to get access to all of our vendors and systems, accountants, back end, all of our operations, softwares, tools, everything we use, all of our vendors, everybody we use, construction guys in all the cities we use, all that stuff, right? You'll get access to all that stuff in the back end. Real estate tax hacks, that's another one. So everybody needs to learn bonus depreciation, cost segregation. That's part of the program. We teach you that. If I could teach everybody on here not to pay taxes for the remainder of your human existence, is that simply worth its weight? If I could literally show you how not to pay taxes and avoid taxes legally for the remainder of your life. So we're going to do that through the tax hack side, okay? Raising capital, all that stuff. So that's all included in there. Plus you'll get the VIP tickets to our live events that we have, but that's all bonus stuff, okay? It's all bonus stuff. At the end of the day, you want to get a result. You're where you're at and where you want to go. I want to see if we can help you, right? And if you want it, let's see if we can help you. So beautiful. So Ann, answer your question. So yes, a type of financing on the program or on buildings. So yes, on the buildings, yes, we have lenders in our system that can help finance all your deals. Answer your question, Martin. Good question. But yes, we have lenders built into the back end of our program that you submit deals to, and they can help with the underwriting as well as providing the financing on that deal. I heard that they have 5-year loans on low interest rates. That's why they're in trouble right now. But if I buy their property, my interest rate is going to be high too. If the number can't work for them and they need to sell, why will it work for me? Beautiful question. This is a great question, Ann. So let me show you how this works. So you are right. There is financing in most commercial loans, just so you know, there is no 30-year fixed commercial mortgages. That does not exist. There's 3, 5, 7, and 10-year mortgages. That's it. So the max is 10 years. Okay. They're amortized over 30, meaning the payments are amortized over 30, but the term of the loan is 3, 5, 7, or 10. So you're right. People that got loans 3 years ago or 5 years ago and they're coming due, and maybe they had an interest rate at 4% and now they're 6%. Yeah, that's a problem. So they have two choices. They either refinance it at a higher interest rate or they sell the property. Now, I can assure you this, and this is kind of where the conundrum lies in. If they don't have to sell, they shouldn't be selling. But people who have to sell will sell at the market value because that's the only value that's going to be able to pay for it. Because the banks, anybody are going to underwrite the property at the new interest rates. And that interest rate, along with the cash flows and all the metrics we're talking about, it has to pencil. Otherwise, you don't buy it, number one. Number two, the bank isn't going to give you a loan, Ann. So it's not even you, it's the bank. So yes, all that has to come together. But that's why you see markets right now where you either have, like, the sellers that have to sell are selling and they're taking losses, sometimes walking away from all their equity because they have to sell, right? They have to sell. Others have bought so long ago that they're selling and there's enough profit in it, it doesn't matter. So yes, you're buying it with new interest rates and stuff, but that's on you. They bought that thing 10 years ago. Their basis is good. They're just selling it. They're making their money and they're moving on, right? It's just it's a cycle thing. It's a time thing for them, but they're good to go. So the distress stuff, if you want to find the distress stuff, you can look anywhere, anything that was bought from about 2021, January 2021, up until about the end of 2022. So about a 2-year window. Anything that was bought in that span, okay, could be in trouble right now. Could be in trouble right now. And so those would be the loans I would be targeting if you're looking for stressed deals. I'd look for loans and properties purchased in that time zone because those ones, I guarantee you, probably struggling. At best, they're breaking even right now, at best. But they're just trying to ride through the storm right now. And if they can, they'll ride through it. If they can't, they're going to sell and take a major loss. And they'll walk away from most of their equity, but that's your win. That's your win, Ann. Great question. So Martin, we do not offer financing on the program, but there are options for figuring out the money. So, but like I said, set the money aside for a minute, make sure that it's something you like and you think it's a good fit for you first. We'll figure out the money. Okay. Yeah. Because I don't ever want that to stop people because I know that it stopped me in the past. And I just know that if I would have allowed it to long term, I'd never be where I'm at. Like I would never like get through the hurdle mentally to get off the cliff and jump and allow the how to show up. Okay. Jim had asked, refi and pay investors at or before 3 years to be the sole owner at a 10-year loan. So typically, just so you know, Jim, the first refinance most times will not pay off all your investors. Okay, it'll give them maybe 30 to 40% of their money back. The second refinance, about 6 to 10 years in, will pay off your investors. But once again, it depends on where you're at in the cycle, right? Remember that property that I showed you? We were lucky enough. We hit that cycle just right, paid off the investors. It's not always that way. Typically, it's 30 to 40% on your first refinance. Second one, you can pay them off. You can pay them off. And now you have sole ownership 100%. So that's great. Love it. You need a good value add. You do, because you need to be able to push the value more than just through rents, right? You need to be able to add value physically to the property, which then obviously increases rents, which increases value. So yes, a good value add will allow you to do that. If you're just buying a turnkey asset today, meaning it's stabilized, it's producing cash flow, done and dusted, and you're just, pumping, they call coupon payments from it. Yeah, your refinance every 5 years is just going to get little bumps. You're not paying off your investors. You're right. How can you sleep well at night knowing your multifamily loans have only 5 to 10 years term? You have to refinance in timing, but no. Yeah. That's just how the market is. I don't know how to, everybody has to deal with it. Yeah, I mean, typically you don't keep in mind, typically you don't have massive swings in interest rate rises in valleys, unlike what we saw. That had never happened before. Like in the history of 100+ years of the United States in the whole financing, never gone up 11 times in 9 months, ever. Typically, it'll go up at quarter points in every, quarter here and there, and you'll see gradual rises to adjust, right? You typically don't see, and that's what happened, and that's what caused the conundrum that's going on. Very rare situation. It's an outlier. Wouldn't count on it, for another 100 years, to be quite honest with you. It's very, very rare. So could it happen? Sure. Not likely. So how do I sleep at night? I know my odds. And I know that if I don't over leverage, remember, don't over leverage, put proper debt on it so you can pay your loan. The banks will always work with you. As long as you're getting their payment, you're making their payment, they'll work with you. Because if everybody's in the same, excuse my language, if everybody's in the same shit show, they have to deal with the shit show at one time. So if all stuff's going to hell, as they call it, they have to deal with that. All the banks are in the same mess. Everybody's in the same mess. So you're in the mess together so that you can work through it. Okay. You can work through it. Great question though. It happened right after the last recession. Interest rates went up a bit, but not crazy. Not like the last time, right, Mel? They went up. You're right. They went up a few percentage points, but not like they did. I mean, we've never seen that before. We'd seen interest rates move up a few percentage points, but then they dropped, right? And then we went to zero. So they went up quite and then went down, but they only went up a few percentage points, not like from 0 to 5. I mean, that was almost 5.5 percentage points. Never happened before. Yeah, thanks for coming in, everybody. Really, really appreciate it. Hope you got a lot out of this. Got the free toolkit. Come in, stay involved in everything we're doing. We're the real deal Holyfield, as they call it. Follow us on all the social medias. And if the timing's not right for you, the timing will be right later. So we are here. We're not going anywhere. And we're trying to grow along with you. And we'll help you get where you want to go. So thanks, Mel, Sir King, everybody else in here, James, Jim, Fred, Denise, many, many, many others. So appreciate everybody coming in. And we will see you next time. Have a great night.